We've been in a liquidity consolidation for quite a while, and those can only last so long because the system is designed such that it always needs more liquidity. And so that plays into a lot of my view of why the next 2 years are probably going to have another up leg in liquidity. And we are off the highs in liquidity, which occurred back in late 2022. So it's not that I think liquidity is going to be terrible. It's just I don't know if we're going to have like a big vertical move in liquidity, which if that were to happen, I think we get that big vertical move in Bitcoin most likely.
About 2 weeks ago, Treasury Secretary Janet Yellen triumphantly announced that the U.S. had achieved a soft landing after years of concerns about the economy following the pandemic's unchecked money printing and multi-decade high inflation rates. "What we're seeing now," Yellen said during a CNN interview, "I think we can describe as a soft landing, and my hope is that it will continue." The remarks came hours after the U.S. Bureau of Labor Statistics released December's jobs report, which came in hotter than expected, with 216,000 jobs added, far outpacing expectations of 160,000 jobs. While the jobs report might have supported Yellen's optimism about the economy's strength despite the unprecedented interest rate hikes, the inflation report released the following week tells a different story. According to the report, the Consumer Price Index rose by 0.3% in December and 3.4% from a year ago. Economists had estimated 0.2 and 3.2% increases. Core CPI also rose by 0.3% month over month and 3.9% compared to the same period in 2022. Economists had estimated 0.3% and 3.8% increases, respectively. While these figures might not be particularly indicative of more economic challenges for the United States, they do not support Yellen's optimism that all is well with the economy. In fact, economists from major financial institutions like J.P. Morgan believe a recession is still more likely than not in the coming months. Economists are also forecasting widespread economic declines for China, Japan, and other major economies in 2024. The consensus is that the global economy is poised for another tumultuous year in 2024, and central banks will have to turn back the money printers to avoid major economic disasters. During a recent interview, Lynn Alden, a renowned macro analyst and investment strategist, describes her outlook for global liquidity in 2024 and beyond. Alden explains that while it's still too early to accurately predict what macro conditions will look like in 2024, the natural conclusion to every cycle is more liquidity, and central banks are about to unleash a record amount of liquidity into the system. The bad news is, this means further currency devaluation. The good news, according to Alden, is that it will be great for Bitcoin prices. This is why Alden believes the leading crypto asset may be primed for explosive price increases within the next 2 years. We will now bring you clips from Alden's recent interview with Blue Collar Bitcoin. Please watch, share, and like this video. Subscribe to the channel and turn on post notifications for more videos like this. Thanks, and enjoy the video.
The Fed is only one input of many into global liquidity. In the US, the big inputs are the Fed and the Treasury together. And then globally, you have to consider other major powers like does China stimulate or not stimulate as well, because they're a huge entity. And so the Fed is one input there. And to some extent, I think that it's not fully in the Fed's control. I mean, basically, when there are liquidity events in really key markets like Treasuries, they kind of lose out to the fiscal side. And so it's less about what the Fed decides to do. It's about the timing of things that will force them to do certain things. One of the reasons I've been a little bit more cautious on my statements throughout 2024 is because I'm not sure if liquidity is going to be really good or not this year. And I do think that Bitcoin is likely to be relatively correlated with liquidity. It doesn't mean that, on a week by week basis it does what liquidity does, but it's so far, at least in the kind of first third of Bitcoin's life, it wasn't really correlated to anything because like if one doctor decided to buy Bitcoin that day, that moved the price. It was small enough, or if someone else sold, that would move the price. But ever since Bitcoin became big and liquid enough, kind of in the second half of its life, and really kind of the second 2/3 of its life, it's had that correlation with liquidity. And one way to think about that is that when you're comparing the Bitcoin and dollar exchange rate, you have to take into account what both of those monies are doing. So Bitcoin is the growing, harder, emergent money. The dollar is the big incumbent money, and the dollar goes through periods of hardening and loosening. On net, it's kind of structurally loosening. That's what it does, but it goes through these kind of periods of hardening. And so when it's doing that, it's pretty rare that Bitcoin's going to do well in that environment because it's getting pushed around by this bigger money that is the unit of account for much of the world. And so I kind of have a very mixed outlook for liquidity this year, or at least the first half of the year. And so when people ask me what I think Bitcoin's going to do, I keep giving kind of a 2-year view because I think I have better visibility on what happens in the 2-year view. I think that liquidity is probably higher 2 years from now than it is now. But over the next 6 months or 9 months or 12 months, I don't really have a firm view on that. And so that's why I'm maybe a little bit more cautious around my statements than a lot of other Bitcoin bulls are, because nothing between $30,000 and $120,000 would surprise me. Because one is Bitcoin's that volatile, and two, liquidity is that uncertain in this calendar year, at least in my opinion. And I try to track liquidity pretty closely. So you have to take into account what is the dollar index going to do compared to other major currencies. What is China going to do? What is the Fed going to do? What is the Treasury going to do? What are banks going to do? Right. So there's multiple variables that feed into that. So it's not that I think liquidity is going to be terrible. It's just I don't know if we're going to have like a big vertical move in liquidity, which if that were to happen, I think we'd get that big vertical move in Bitcoin most likely. But I don't know if that happens this year, next year, maybe between the 2 years, some point. And so that's kind of how. And if you look at the halvings, I mean, the halvings are relevant for Bitcoin, but sometimes the bull run is happens right around that time. Other times it's delayed for a period of time, and that's in large part because the actual timing tends to be more correlated with that liquidity component. The halving plays a really big role in terms of I think why it has higher highs and higher lows. I think it plays a really big role in the bear markets like 2 years later when not that many people want Bitcoin anymore, and there's still Bitcoin coming to market, but it's less because of the halving. That helps set the higher floor. The kind of the hodlers of last resort have less supply to absorb. But in terms of timing around the halving itself, I think liquidity is generally a bigger catalyst.
By all indications, liquidity is going to be a major concern in 2024. Ironically, the problem won't be a result of depleting but increasing liquidity conditions. According to new reports, the International Monetary Fund is watching for potential market liquidity risks as countries are expected to begin refinancing the debt issued during the pandemic. Last week, the IMF's first deputy managing director, Geeta Gopinath, told Bloomberg News that the extremely high debt levels mean a massive wave of liquidity is about to be unleashed on the global economy. Debt is at extremely high levels, she said. What worries me on top of that is that we have projected fiscal deficits that are going to be higher than they were pre-pandemic. Many countries borrowed a lot during the pandemic. That was short-term in nature, and that's coming due, so I think liquidity risks are something we should pay attention to. The remark from the IMF deputy director ties nicely with Alden's latest predictions of a liquidity pump in 2024 or 2025. Let us know your thoughts as we bring you more clips from Alden's interview. This time, she discusses the monetary and fiscal policies in the U.S. and how effective the Fed's rate hikes are.
So there's monetary policy and fiscal policy, and when the two go in opposite directions, usually fiscal policy wins, but it's not always a smooth ride. It can be very bumpy. And so monetary policy refers to basically what the Fed's doing, or in another country, what that central bank is doing. And that basically is what are short-term interest rates set at, because it's essentially controlled interest rates, and then also balance sheet. What is the changing of base money doing? Because that affects liquidity. So those are the two variables primarily that the central bank has to play with, whereas the fiscal side is more about how much is being taxed and where it's being taxed from, and how much is being spent and where it's being spent, and then specifically the delta between those two. So how large is the deficit and who primarily is receiving a lot of that deficit. And they can go together. Like, for example, during the pandemic lockdown stimulus response, you had both. You had the fiscal authority spending a lot of money, but as they're issuing trillions of dollars of bonds, the Federal Reserve is creating new base money and buying a lot of those bonds. And so you're printing money, but then you're also getting it out into the people's pockets. And so, but ever since we started to get inflation, the Fed's been tightening up. So they're saying, okay, we're raising interest rates and we are reducing our balance sheet. But the fiscal side is still they're not doing like stimulus checks anymore, but they're still running a structural, largely demographics driven deficit. And what makes it complicated is that as the Fed raises rates, it loosens the fiscal side even more because it raises their interest expense. And someone out there is receiving that money. It could be the foreign sector, it could be banks, it could be insurance companies, it could be upper middle class or wealthy people that have a lot of cash
Us in
equivalents,
money markets. Yeah,
exactly. So people are receiving that money, and that has some propensity to be spent. It's not as rapidly spent as stimulus checks tend to be, but it is income to various entities that can go out and spend it. And so the way that I keep describing that is, so back in the 70s, like money creation comes from two sources, either that monetized fiscal deficits or bank lending. And the central bank, the monetary policy is mostly designed around controlling bank lending. So things that encourage them to lend more or things that encourage them to lend less, or the other way around, people to borrow more or borrow less. And so in the 70s, most of the inflationary money creation we had, the majority of it was from bank lending. And that was in large part because the baby boomers were entering home buying years. So there's a lot of demand for credit and there was a lot of provision of credit. And so you had a lot of broad money supply growth at a time when we also had, we were running fiscal deficits. We also had oil shortages, things like that. But the biggest component was that money creation, the lending. And so we had very low public debt to GDP. And so when the central bank raised rates very high, kind of the classic Volcker, the well-known historic Volcker moment, that put a big brake on bank lending. And although it did increase the fiscal deficit because it increased the interest expense of the government, it was less, the downward push on banks was bigger than the upward push on the government because the government debt was so low. So if you raise interest expense on 30% debt to GDP, that's only so impactful. Whereas if most of the money creation is coming from bank lending and you kind of slow that down, that the monetary side is winning there. On the other hand, if you fast forward 40 years and now debt is 130% debt to GDP, when the central bank raises rates, on one hand, they do slow down the bank lending. We've seen that in the data. Bank lending is kind of at stall speed right now. It's very slow. But now there's just more and more interest expense pouring out into the economy from the government. And so that magnitude is roughly equal, right? So kind of the slowdown in bank lending is roughly equal to the increase in interest expense. And if you fast forward even further, you get to like a Japan situation. If they raise rates, it'd probably be outright pro-inflationary because the fiscal side would be actually so much bigger than the loan side, whereas we're more in that middle range right now, which is partially why their tools are not as effective. And that kind of is the hallmark of an end of a major cycle, like a long-term debt cycle.
According to Alden, we are now at the end of a 50-year cycle, starting with the unstable economic conditions of the early 70s, which saw people struggle to adjust to the newly introduced fiat money system. Then came the more stable conditions of the late 70s and early 80s, followed by the subsequent multi-decade stock market bull run, which ended with the dot-com bubble burst. The burst prompted central banks to re-stimulate the economy, and by doing so, they pushed up a big housing bubble, which later caused the widespread banking collapse of the Great Financial Crisis. Alden added that when central banks swooped in to rescue the banks with multiple rounds of quantitative easing, they pushed the bubble to the sovereign level. This means there's nowhere else to push the bubble now, and it's only a matter of time before there is a more powerful burst, this time at the sovereign level, and it could completely bring down everything. What are your thoughts on Lyn Alden's predictions and outlook for Bitcoin and the global economy? Don't forget to drop your comments and observations in the comments section below. Like this video and subscribe to the channel for more. You can also check out our other videos featuring insightful analysis and predictions for Alden and other brilliant analysts and prominent investors. Thanks for watching.